Hey everybody, it's Brian. Thank you very much for joining me today. Today we're doing our next lesson in Trading 101, and today we're going to talk about the markets, the different markets that you can trade and characteristics of each one. So let's go ahead and get to it. I know I've made a commitment to keep these lessons short, about 15 minutes or so. This one will be longer. I've tried recording it multiple times, and there's just no way for me to get this down to 15 minutes. So stick with me on this one. This will probably be a little bit longer, maybe closer to a half hour, but it's good information that'll give you some basic characteristics of each of the markets that are out there. All right, so let's go ahead and get started. First things first, I always have to let you know that I am not a licensed investment advisor. I don't pretend to be one here. I'm just showing you information, tools, methods, things that I have learned through the years of trading and trading education. Trading does involve risk. I know we've been over this a number of times, but it's very important that you trade with only risk capital. While there's a huge potential for reward in trading, there's also the flip side of that, which is a huge potential for loss. So make sure that we're only trading with capital that we can afford to be without if something happened that's not going to plan. All right? So let's go ahead and jump into it. Today's goal, as I said, is to identify the main markets that are out there that we can trade, give you some information on the basic characteristics of each one, and then get you thinking about which one might be right for you to start looking at and learning more about in future modules, right? We are going to dive in to the specifics of each market and the strategies after we get through the 101 course. I've got to get a foundation for you first. All markets are exchanges. They basically operate like an auction house. You've got buyers in the market, you've got sellers in the market. They negotiate prices and make trades at levels that they're willing to do business at. Supply and demand is what determines price. It's really the only thing that determines price. You've got to have buyers and you've got to have sellers in order to have an active market. Buyers are putting in orders at what's called a bid. This is the highest amount that they're willing to pay. And sellers are in the market putting in orders at what's called an ask. This is the lowest amount that they will take for the item that they currently have. Liquidity in the marketplace, or the instrument that's being traded, determines how easily you can actually trade, how easily you can exchange that product. And this also affects how rapidly price can move up or down. Most markets are offering some sort of a margin, and what margin is borrowing money to purchase or control more of a specific instrument or asset. Right? We'll get more into each of these things and the actual application of them down the road as we start talking about each specific market and some strategies and ways that you can utilize those markets. Right? The main markets are the stock market, the futures market, the Forex market, which is foreign exchange, and the crypto market. That's one that's really emerging and has been very exciting over the last couple of years. Now, we are going to start breaking all this down, but I do want you to keep in mind, I've said it over and over and over, this is a 101 course. We're just simply setting a foundation here. There's going to be a lot of stuff that I'm going to leave out at each of these markets. So if you're a more experienced trader, you've got experience in these markets, don't go emailing me going, Brian, you missed this, and this. I know I'm leaving out a lot. I'm just trying to hit the overview of what each of these markets are so that we can have a good kind of a level set for everyone that's watching and is out there, because we've got to have a good foundation. If we skimp on the foundation and there are folks that don't understand the sheer basics of something, if we don't have a good foundation, the rest of what we build on top of it won't be stable. Right? So what is the stock market? The stock market is a place where investors connect to buy and sell investments. Most commonly, they're selling stocks, or which are shares of ownership in a publicly traded company. The items that are traded in the stock market, there's a lot that's traded out there, but most common, you've got stocks, equities, you've got ETFs, which are exchange-traded funds, you've got bonds, and you've got options that are traded on stocks. The stock market is really worldwide. There's stock markets in every country. But generally, when people are referring to, quote, the stock market, they're typically talking about the New York exchanges. And this little graph here on the screen will show you why. The NYSE and the NASDAQ, the volume that's traded there is just dwarfs the other major markets that are out there. So when we talk about the stock market, we're talking about the NASDAQ or the NYSE. The hours that the market trades really comes down to a few key sessions. You've got early trading, which starts at 7 a.m. Eastern and goes until 9:30. You've got that core trading session. This is when the bell rings and all the activity goes live on the floor. That's from 9:30 to 4. And then you've got a late session that goes from 4 to 8. Options are traded mainly during those core hours of trading, during that active session, during the business hours, the main business hours, live business hours. How much do you need to get started in the stock market? Well, look at it this way. The minimum stock on the NYSE is $1. It's actually pegged to $1. If it drops below that for any period of time, for actually a fairly short period of time, it's suspended and then potentially delisted. So the minimum stock price on the NYSE is about $1. The highest price stock on the NYSE is Berkshire Hathaway, their A shares, which are over $300,000 a share. The average, though, is probably around $60. So just keep that in mind. If you're going to start trading stocks, average stock, 60. Quite a few that are lower, but average is about 60, right? So if you plan to just buy stock and start a trading account, a very small trading account, you can do that with $500, going through E-Trade or someone. If you're going to trade on margin, then you need a little bit larger account. I think TD Ameritrade has their smallest account, I think, is around $2,000. So realistically, you'd have to figure out what it is that you plan to trade and how you plan to trade it in order to really back into how much you need to get started. If you're going to trade, let's say, covered calls, which is a kind of a basic options trading strategy in which you buy shares of stock and then you write options against it. It's called a covered call. Very safe and basic trading strategy. We'll talk more about that as we get into options trading. But in order to do that type of trade, you first have to buy 100 shares of stock because options contracts are written in groups of 100. Each contract is worth 100 shares. So you have to have 100 shares of stock first. So if you were going to do that type of a strategy, you would have to have enough funds to cover that purchase of stock. So that's just a kind of an example of how you might back into how much money is needed to get started with trading in the stock market. But you can start with as small as $500. But really, most stock and option trading accounts, you're looking at $10,000, $15,000 or more. Realistically, I mean, of course, again, people will argue that with me. There's different sides of that coin. You can certainly do a lot of things with options with much smaller accounts. But in my opinion, most stock trading, option trading accounts are at that higher level of account size. What broker should you use when you're getting started? Well, again, I'm not here to recommend any specific broker or brokerage. What I would say is just do your research and find out which one works best for you based on the instruments that you're trading. Every broker out there has pros and cons. There is no perfect brokerage. Some examples of brokers are E-Trade, Fidelity, Ameritrade, Interactive Brokers are some that are out there. Personally, I use Interactive Brokers, but that's in no way a recommendation or an endorsement. It's just who I use. They definitely have a lot of cons, but they've got a lot of pros as well in my book. All right, so next up is the futures market. What is the futures market? We hear a lot about this. Well, futures market is a place where we buy and sell commodities and future contracts for delivery based on a specified future date. And this little screenshot is taken from FinViz, which is a website that will give you a pretty nice dashboard like this to show you what the different products in the futures market are doing. The futures market they're traded in different places. Some examples, and there's certainly more than this, but some examples of future markets. You've got the NYMEX, which is the New York Mercantile Exchange. You've got Chicago Mercantile Exchange and Chicago Board Options Exchange. And there's others out there. Those are just some common examples of futures markets. The futures market gets its origins in the commodities industry. And that actually goes way back, but we'll talk more recent. Basically, what it is the producers of tangible goods, like oil and people that are producing gold and rough rice and hogs and so on and so forth. Anyway, they wanted a way to manage their risk of having to accept an uncertain price for their product in the future, right? So they said, hey, how can we create something that allows me to know what my sell point is going to be, X number of months from now. So future contracts were the answer for that. And futures now go well beyond commodities, as a matter of fact. There's futures contracts that are based on stock market indexes, long-term treasury bond, and even foreign currencies. So there's a lot of different contracts that are out there, but they're all based on things that are going to happen a month from now, 2 months from now, 5 months from now, so on and so forth. They're based on things that are happening in the future, which is why they're called a futures contract. We're speculating on what's going to happen down the road. So how it works basically is under a futures contract, a seller agrees to sell a fixed amount of a certain asset to a buyer for delivery on a particular day in the future. And the price that the buyer is going to pay the seller is set on the prevailing market price at the time that they enter that contract. So that's how it works. Some examples of some really high and very liquid futures contracts, meaning there's a lot of exchange and a lot of activity taking place out there, would be the ES, which is the S&P E-minis. You've got crude oil, NASDAQ, the NQ, NASDAQ 100 E-minis, gold. Those are very liquid markets, meaning there's a lot of activity taking place. Some examples of illiquid markets would be like rough rice and oats. At the top half of this, you've got hundreds of thousands or even millions of contracts being traded on a daily basis. On the rough rice, on the oats, you've got hundreds of contracts, maybe thousands of contracts. So there's a huge disparity. Liquidity is really important because it's what allows the market to work efficiently. With a low liquidity market, there's more opportunity for very wide swings and big price fluctuations. So we always want to trade in liquid markets. So we'll get more to that as we start talking about actual market strategy and different things in future lessons, right? The trading hours for the futures market basically are around the clock nowadays thanks to electronic trading. Many can be traded beginning on 6 p.m. Sunday and rolls through 5 p.m. on Friday afternoon Eastern Time. Volume is heavier during certain times of the day for certain products, as you can imagine. There are operating hours where things are exchanged more highly, but through electronic trading can happen kind of throughout the day. I would suggest, though, do your research and trade the product that you're looking at during the most liquid times, the heaviest volume for that specific product. There is a 60-minute settlement break daily from 5 to 6 where no trading takes place at all. And if you want to dig into the full trading hours, they are the CME Group's website will show you the trading hours for every specific asset and instrument that's out there that can be traded in the futures market. So you could check out that site, cmegroup.com/trading-hours.html, if you wanted to dig in to the specific hours for each one. But do your research and figure out which ones, if you're going to trade a certain thing, there's going to be heavier volumes at certain times of the day, and I would recommend that you're in the market during the most liquid times, right? How much do you need to get started trading futures? Well, a little bit less than you would need to start trading stocks, in my opinion, but it does depend on what you're trading. Different contracts have different values per tick. A tick, and again, we'll get into this as we start talking about futures specifically, but a tick is the smallest increment that a product can move by. And that's a sign. The tick values are varying per instrument. And also the different products have different margin requirements. The margin requirements are set by the broker. They can vary from broker to broker. But just a quick example, so you can kind of back into or do some back-of-the-napkin math on how much you might need to get started. S&P futures, for example, have a tick value of $12.50. And there's 4 ticks to a point. So basically each point is worth $50. So if you were going to use a recommended risk of 1%, then you would need a $10,000 account in order to take a trade with 1% risk and a 2-point stop loss. Now, that might be Greek to you right now, but that'll make more sense as we start digging into futures. I think most people that trade futures would agree you probably need at least a $5,000 account to start getting into futures and be able to trade multiple assets with a fairly low amount of risk. I mean, again, we want to keep our risk levels down to that 1 or 2% without going crazy. And again, I know that's even one of those things that people would argue. Trading's so diverse. There's a different way to attack any problem. Obviously, there's going to be different opinions depending on who you talk to about it. I like to keep risk very low. So in doing that, you do need slightly more to start. But I'd say probably minimum of $5,000. I think some might even say as low as $3,500. But I think $5,000 is, in my opinion, a good place to start in the futures market. What brokers should you use? Well, brokerages that operate in the futures market are actually many of the same that operate in the stock section. So we talked about them already. They all offer futures trading opportunities. Some others to consider would be TradeStation and NinjaTrader. Those are different charting platforms that also offer trading opportunities. All right, next up, the Forex market. What is the Forex market? Well, Forex is short for foreign exchange. And this is where participants buy, sell, and exchange currencies. Now, there is no central exchange. Like in the stock market, we've got the NYSE, we've got the NASDAQ. Those are centralized exchanges for the products that are being traded on them. In the futures market, the same. We've got a centralized exchange where all of the gold futures go through a certain exchange, or lean hogs go through a certain exchange. Those are centralized exchanges. In Forex, there is no central exchange. It's a global network of banks and brokers around the world that are doing business with one another. And Forex is widely accepted as the most liquid market out there. There's over $5 trillion a day traded in Forex through the various types. You've got, obviously, we'll get more into Forex and the history behind it and what's actually traded, but it is the most liquid market with $5 trillion a day in transactions that are running through that market. And if you look at the graph down below, you can see where Forex stacks up against other markets that are out there. And that graph is actually, you're looking at the right-hand side there, the $5 trillion, that bar size is significantly inaccurate when you're comparing it to the futures market, which is basically $400 billion that's out there. So you look at $400 billion versus $5 trillion. It's an amazing market to trade. Very liquid, meaning that you can get in and out pretty much whenever you want to in the Forex market. The history behind Forex, just a quick history behind it. Prior to World War I, countries operated on what was called the gold standard. And what that meant was that a country could only mint as much currency as there was gold held in reserves. Now, during the wartime, during World War I, World War II, countries suspended that conversion into gold. They needed to print more money in order to finance the war efforts. So after World War II, we saw a lot of economic instability, and countries got together. They agreed. They had this Bretton Woods agreement, which brought 44 nations into an international monetary system, which was designed to control fluctuations and restore economic stability post-war. The IMF, the International Monetary Fund, was created at that point to regulate the IMS, the International Monetary System, and that lasted for about 3 decades. And then in 1976, the Jamaica agreements were created and Bretton Woods was abandoned, and this is when that floating exchange system was created. So the Forex market, as we know it, is actually fairly new. It was created after I was born. It's a fairly new thing. And there's a lot more we could go into. If you really wanted to dig into the detail behind this, we could go into a lot more depth. But it's a really interesting history of how Forex came about. Basically, though, from 1976 on, we've been using this floating exchange system. And as technology has improved, as the world has gotten smaller and capital flows between countries, we do a lot of international business now. As these capital flows have increased, trading has become more and more accessible to individual traders and investors. When it first started, it was really just banks doing business with one another. But now it's through technology, it's made it available to all of us. And really now, since the mid to late 90s, is through electronic trading and the internet, it's made it available to all of us, to you and me. Trading on Forex, because there is no central exchange and because all of these markets overlap with one another, trading takes place 24 hours a day, 5 days a week. It begins on Sunday evening here in the U.S., which is Monday morning in Sydney. So it starts with the opening of the Sydney market, and it goes all the way through 24 hours a day until the U.S. markets close on Friday afternoon. So it trades 24 hours a day, 5 days a week. Trading in Forex is pretty interesting. It's what we're doing is we're not actually taking delivery of a specific commodity. In Forex, what we're doing is we're simultaneously purchasing and selling two currencies. So a very commonly traded currency is the euro versus the dollar. So we might be simultaneously buying euros and selling dollars at a specific exchange rate where people are willing to do business. And we'll get more into this as we start talking about Forex trading specifically. But basically, we're trading on fluctuations on this floating currency pairing price all the way out to the fourth decimal, which is called a pip. If it's in the yen, it's actually the second decimal, but that's, again, discussion for a later time down the road. But we're trading on fluctuations out to the fourth decimal point, which are called pips. And we trade in lots of 100,000 units. Now, through electronic trading and through margin offers, brokers actually allow us to trade much smaller sizes than that. There are mini and micro lot sizes that brokers allow us to trade, which makes foreign exchange trading very accessible to people with smaller accounts. So it takes a much smaller balance to get started. How much do you need to get started in Forex? Well, accounts here can be opened for as little as $250, depending on which broker you go to. All of the trading is done on margin, so you do need to have funds available for margin requirements with your broker. But again, if you're trading these very small mini and micro lot sizes, there isn't a lot of margin associated with that. Usually it's $50 to $100. Margin requirements do vary from broker to broker, and they also vary by the currency pairing that's being traded. Depending on the liquidity and volatility of that specific pairing, there might be more or less margin required there. In my opinion, $500 to $1,000 is probably the minimum that you would want to use to start actively trading in Forex. Again, going back to what we talked about a couple days ago, every broker in every market offers you some sort of a demo or practice account, paper trading account, so you really don't need anything to get started. But when you do plan on putting live money in, something to consider is you can get started in Forex trading with a very small account balance. And again, we'll dig into more of these as we get into each of the specific market structures and ways to trade those markets. Which broker should I use? Well, I think it's best to use a specialized Forex broker. A lot of the brokerages that you can use to trade stocks and options and futures aren't actual Forex brokers. There are brokers that deal specifically in foreign exchange and have those relationships with large networks into that global network of banks and institutions that are trading in the Forex marketplace. Now, here in the U.S., we are fairly limited. There's only 3 out there that we can utilize, which is IG Markets, Oanda, and Forex.com. Outside of the U.S., you have a ton to choose from. There's a lot of great brokers. Obviously, the 3 that I just mentioned. You might also consider LMAX. The LMAX exchange is an amazing exchange that a close friend of mine in Europe uses. But there are a lot of options out there. Do your homework, though. I would recommend choosing a larger broker over a smaller. Definitely do your homework when it gets into that. These 4 that I have on the screen here are definitely the larger players in the marketplace out there. And that brings us to the last market we'll talk about, which is the crypto market. This is the new kid on the block, but it is growing rapidly. Crypto trades 24 hours a day, 7 days a week. It does not sleep, and that's because it's decentralized, totally, trades throughout the world, and it is made up of a lot of different ways to make money. Crypto is a disruptor. It is an exciting marketplace to look at and be in. On a high level, just in a nutshell, it's made up of coins and tokens. We'll get more into what each of those things are as we start digging into crypto specifically with a whole module set on crypto. I was trying to, as I was putting this together, I was trying to figure out what to talk about with crypto, and there's so much to talk about here that I could not really nail it down. Every time I would think of one thing to say, 5 other ideas would pop up. I'd spend an hour and a half just talking about crypto. But the high points are, there's a few different ways to trade it. You can trade by converting your fiat currency into cryptocurrency and then going back to fiat. What that means would be you take your government-issued currency, which in my case would be dollars. In your case, it might be pesos or yen or euros or whatever it might be. But you trade your government-issued currency, which is called fiat currency. You go and you convert that through like Coinbase or Gemini into some sort of a crypto coin or token. And then as that increases in value, you convert it back to fiat. Right? So that's one way to trade. Then there's just simply buying and holding. A lot of folks feel like Bitcoin is going to, it's back on an upward swing again. It had that parabolic run up in 2017. It came back down pretty hard in 2018, and people feel like it's on its way back up. Who knows who's right on that? It could stay where it is. No one really knows. But buying and holding is another way to trade crypto, which is you just simply buy some Bitcoin or buy some Ethereum or some major coin and just hold on to it. And then, of course, the last way to get to trade crypto is to actually trade crypto to crypto. So buying, just like you would trade foreign exchange, right? Just like we're trading in Forex, you might trade, seeing fluctuations between the values of Bitcoin and Ethereum or Ethereum and Litecoin or whatever it might be. You can trade those fluctuations as the market ebbs and flows. There's a lot to talk about here. There's so much to talk about because beyond trading, there's a whole list of ways to make money in crypto, and it's really exciting. It's such a market disruptor, and it's such a infantile market. It's brand new. It is in its infancy. It's a baby. So there's a lot happening here and a lot to get really excited about in crypto. But if you are going to start trading in crypto right now, I would recommend that you stick to the high volume coin. Sticking to the high volume coins will give you a better opportunity to get in and out if you are actively trading it. One thing with crypto is right now it is kind of a complicated process to get into it. So you need a place to buy it and you need a different place to actively trade it. They're not often the same platform. But again, we'll talk about that as we get into crypto specifically. How much do you need to get started? Well, there are no minimums in crypto. I mean, you can get started, for a very small amount of money, $25 to $50. There are many fairly liquid coins that are less than $1. So you could buy a large volume of coins with a small amount of money right now that are fairly liquid and heavily traded coins. What's the upside to them? No one really knows at this point. Bottom line is you can get involved with a very small amount of money. You can actually even buy fractions of a coin. So you don't have to have, $5,000 plus to buy a Bitcoin. You can buy a portion of Bitcoin for a small amount of money, $50, $100, whatever it might be. In my opinion, if you're going to actively trade in the crypto space, get started with $250 to $500. But you can start with anything. I mean, if you just wanted to start putting a little bit of money aside each week and investing in a certain coin that you feel like has a large potential future value, then just start buying some of that coin. $20 a week, $50 a week, whatever it might be, if you're going to buy and hold. You don't have to have a lot of money to get involved in crypto. And I'll just leave it at that. There's a lot to talk about here. We'll do a specific module series on crypto. So that's it for now. I hope I've kept this fairly short. I don't have a timer running to see how long I've been going for. But today we've talked about the different markets that you can trade. There are a lot of different markets that you can get into. They all have a variety of different trading hours, so that means that you can look at the markets that you're trading, figure out when the most active times are, and you can find a market based on your schedule, your location, your free time that you could participate in. And there are markets for any budget that's out there. One thing that I often hear from people as I talk about trading or talk about what I do, they think that it takes a lot of money to get started. They think you've got to have these huge sums of money to get started in trading. And the reality is you simply don't. You don't need to have a lot of money. I think for me, the biggest thing is just getting started. Take what you have, take that true disposable capital, that risk capital that you have, and put it in something and learn how to get that money working for you. So you've worked to make the money, now let the money make money for you. Obviously with a little bit of direction and input, but it's not the same as continuing to work 40, 50, 60 hours to constantly make new money, right? Once you've made the money, let the money work. And if you just start with a small amount of money and see how that can happen and see how those things can multiply, then that might inspire you to find ways to create more or put aside more that you can put into these pots that are now working for you. So that's it for me for today. Tomorrow we're going to come back and we're going to talk about charting and how we look at the market, how the prices are displayed, the different time frames that we might trade from, the different trading types that are out there, the scalper, which is the very heavy, high volume in and out, the intraday traders, the swing traders, position traders, so on and so forth. We'll talk about those different trading types so that you can get some ideas of how active or inactive you want to be in the marketplace. It's just some opportunity that's out there. And then we'll keep building on that and get into actual strategy creation and so on and so forth down the road. All at a very high level. This is our foundation course. But I think by the end of this, you'll have some really good information, actionable information that you can get started with before we begin digging into specifics of each of the other markets. All right, so that's it for me for now. You guys have a great day, and I'll talk to you soon.